We often look at corporate strategy through the lens of growth, but what happens when the market really turns against you?
Right.
Specifically, when the high-end consumer sector becomes, and this is a direct quote from the executives we're looking at today, choppy and messy.
Mm.
It forces a company to do more than just, cut costs. They have to execute this sophisticated, rapid adaptation.
That's really the crux of this deep dive. We are peeling back the curtain on a major furniture retailer, Lovesac, using excerpts from a very recent corporate Q&A session.
Yeah.
So this isn't, external punditry. This is the leadership detailing line by line how they're navigating all this turbulence and transforming their business model at the same time.
It's a fascinating case study. In our source stack, it's telling us they are making two massive interlocking strategic shifts. The first is launching and scaling a comprehensive circular economy effort, which they call re-commerce. And the second, which, this speaks directly to the current economic environment, is this really disciplined decision to delay a huge, expensive product line launch in favor of what they call harvesting the brand.
They're essentially building a financial fortress while redefining their customer relationship. They have to manage today's headwinds, which are significant, but at the same time, they're refusing to sacrifice the strategic advantages they're building for tomorrow. It's a real high-wire act.
Okay, let's unpack this, and let's start with the most innovative element here, the circular strategy they call the program Loved by Lovesac. For anyone listening who might be eyeing a purchase, what's the reality of this re-commerce effort right now?
Right now, it's really all about capability. They are rolling it out deliberately, focusing intensely on building the necessary logistics and infrastructure.
Okay.
So they're currently active in 27 states. And the focus is on the immediate resale of pre-owned items. This is them building the muscle memory for a much, much larger future effort.
And what does that mean for the consumer today? If I want to buy a pre-owned Sactional, what kind of deal am I actually getting? Because the price has to be right, to motivate someone to buy used furniture.
Oh, yeah. The pricing is strategically positioned to be highly appealing, and it reflects the fact that the product is designed for longevity. Customers can expect a really deep discount of around 20 to 25% off the price they would typically pay.
Wow.
Even factoring in regular sales or, other promotional discounts, that is a significant saving.
That large a markdown for used goods is really a statement about the original product quality.
It is.
If the material is truly designed to last, they can confidently offer it at that percentage off and still manage their margin.
Exactly. And to manage inventory and quality control, they've already set up two distinct tiers for the condition. So they grade the products as either practically new or just good. This simple distinction, it drives the pricing and it manages customer expectation, which is just critical when you're trying to build trust in a new re-commerce channel.
That makes a lot of sense. But the source material makes it really clear that the immediate goal of just selling refurbished couches isn't, it's not the end game. This is all preparatory work for something much bigger.
Absolutely. The leadership was very clear. They said that this current effort is largely about building the infrastructure and capabilities so they can unlock trade-in next year.
Next year.
They're targeting fiscal year 2027 to implement a major trade-in capability, which they believe will be, and this is their word, incredibly powerful.
Powerful how? A couch is a couch. Why would a furniture trade-in be such a game changer? Isn't that just like a discount on the next purchase?
It's fundamentally different from, say, trading in a car or a phone because of their modular design.
Okay.
Think of it less like a single product sale and more like an Apple upgrade program for your living room. The power lies in creating this perpetual customer lifecycle. Because the Sactional is so durable and modular, the trade-in allows customers to upgrade components, not the whole unit.
I see. So I'm not trading in my entire couch. I'm trading in my old covers for new ones, or maybe I trade in a section to afford the new innovation, like that built-in recliner.
Precisely. It incentivizes the customer to remain within the Lovesac ecosystem for life. The company converts what would typically be a single, huge transaction into a whole series of smaller, high-margin upgrade transactions over decades.
Right.
This is how they build a deep, powerful competitive moat that other modular furniture companies just can't match. They're guaranteeing a future resale or upgrade value for the original purchase.
That is the blinkest insight of the whole re-commerce pivot. It's not just a new revenue stream from used goods, it's a strategic move to manage the asset lifecycle and boost lifetime customer value. Okay, now let's pivot to section 2, because this strategic innovation is happening against a really challenging macro environment. And that context is what forced some of these difficult near-term decisions.
Yes. The executives painted a very clear picture of economic divergence. So while the overall furniture industry might be seeing small signs of improvement, their specific high-end sector is still contracting severely.
They cited specific kind of jarring numbers. What was the comparison they provided?
They cited November data. It showed the overall furniture industry was down a moderate 3%. But their area of competition, the high-end premium sector, was down a far steeper 11%.
11%.
That is a stunning threefold difference.
Wow. Why do you think that specific premium segment is getting hammered so much harder than the general market?
Well, it speaks to the psychological impact of, interest rates and economic uncertainty on affluent consumers. The general industry includes quick replacement purchases.
Right.
But a high-end Sactional is a major considered purchase. When wealthy consumers feel uncertain about the future, they postpone those big discretionary high-dollar value items. And that just disproportionately impacts the high end.
And this challenging backdrop, combined with some tough comparisons from previous years, led to their abundance of caution regarding their fourth quarter financial outlook. And this caution is what triggered the big strategic delay, the pushback of the new room launch.
Correct. They decided to push the launch of this major new product line, the new room, all the way until early calendar 2027.
2027.
They want the macro environment to be more stable, allowing them to execute a big splash launch with great gusto. Launching a major new concept is incredibly expensive, and they don't want to debut a flagship innovation into a contracting market.
But wait, if they believe the market will recover in 2027, aren't they risking giving their competitors a massive, maybe even a year-long head start by sitting on this major innovation? That seems like a big risk.
It's a calculated risk, for sure. But the alternative, a weak, expensive launch that requires heavy discounting just to get any traction, is arguably worse. Their immediate priority is what they call harvesting the brand.
That phrase, harvesting the brand, is one of those corporate terms that, it needs translation. What does that mean tactically for the listener?
It means focusing on efficiency and immediate profitability. So instead of pouring huge amounts of cash and resources into launching an entirely new product category, the new room, they're optimizing their existing infrastructure and products to make more money off of the existing assets.
So instead of a brand new product, they're focusing on these incremental, less risky launches.
Precisely. They are launching new products that are quick to market and less costly to launch because they're closely related to the core Sactional platform. The new sectional sofa platform, for instance, is an iteration on what they already do best.
I see.
This disciplined approach builds a much more robust financial situation and cash position now, ensuring they're fully funded and stable before they swing the bat hard on the major new line in 2027. It's just disciplined fortification.
Let's drill down into the sales dynamics, because we have a very clear picture of consumer shifts in the last quarter. They identified Q3 as a definite low point. Where did that financial pressure come from?
The demand pressure hit right after Labor Day, and it was concentrated squarely in the smaller, lower-dollar transactions, specifically items under $6,000.
Okay.
These are typically the smaller Sactional setups, and this weakness was amplified because they had implemented a second price increase, which made those smaller entry points feel a lot more expensive.
It sounds like the value-conscious shopper was feeling the squeeze and walking away from those smaller purchases. And did this affect the entire country equally?
It was broadly national, but they did observe a little bit more of a challenging performance in a few states, such as Florida and Texas. These regional pockets might suggest, localized housing or consumer confidence issues unique to those markets.
But the internal story quickly turned around in Q4, which shows that their rapid strategic adjustments really worked. They cited positive quarter-to-date sales comparisons. What exactly drove that immediate recovery?
The recovery was driven by two complementary trends. First, they managed to stop the slide at the low end. Their adjustments, which likely involved targeted promotions and optimizing their digital outreach, led to a big step up of improvement in those under $6,000 transactions.
And helping that low end is the introduction of their newer, more accessible platforms, right?
Exactly. The Snug platform, which is their newer, more approachable seating system, often comes in at a lower entry price point, It's ramping up. It's helping them fill in some of that weakness. And it proves that the customer wants products from the brand, even if they can't commit to a full high-end Sactional yet.
So Snug is kind of the gateway drug into the ecosystem. What about the other end of the spectrum? Were the high-end customers still spending?
Oh, they were. And they are responsible for the second major trend, premiumization, which is driving a higher average order value. The customers who are spending are investing heavily in upgrades. They're buying more recliners, adding more storage solutions, and choosing the most premium fabrics and covers. It shows that while the transaction count may be under pressure, the quality and total value of the transaction still happening are incredibly high.
And all this growth energy is supported by continuous, quick product innovation, which is part of that harvesting the brand strategy. We heard about the Pillowsac Junior, the Accent Chair, and the Swept Arm editions. It sounds like they're constantly refreshing the core line to keep customers interested without needing that massive, new, expensive launch.
They're maximizing the existing framework. They're keeping the product fresh, dynamic, and giving the sales teams new talking points without needing to build an entirely new supply chain or marketing campaign from scratch.
Now we'd have to talk about the rapid-fire transformation of their marketing engine. This is fascinating because they said they saw results in a matter of hours and days. That is lightning speed for a company of this size.
It really demonstrates the difference between old media and new media feedback loops. Their major tactical shift was an aggressive move away from traditional media formats, specifically linear TV,
Right.
which provides slow feedback and high costs. They are now leaning much heavier into paid influencers and programmatic digital channels.
And because digital channels give you instantaneous data, they could react and adjust their spend and targeting almost instantly. That's what led to that immediate positive Q4 performance.
Correct. And that transformation extended right to their digital storefront. They implemented an overhaul of the website configuration experience, noting that those changes turned around performance in hours and days.
Yeah.
The web is now performing at a much higher growth rate than the total company, which proves that for a modern retailer, the website is the most critical, efficient store they operate.
Looking ahead, what's the next step in bolstering the brand?
For Q1 and Q2, the focus shifts to brand storytelling. They want to move beyond just conversion tactics and focus on highlighting the intrinsic value and versatility of their products to, as they say, claim the territory that is uniquely Lovesac. This is crucial for maintaining pricing power long term.
Speaking of pricing, they had to fight hard for conversions in Q4. The competitive environment meant they had to simplify their promotions drastically.
They did. When your competitors are screaming 80% off, relying on complicated personalized discount codes, it just confuses the customer.
Yeah.
They realized they needed to be bolder and clearer, so they moved away from discrete personalized offers to a strategy of going full throttle with a winning promotion, making them simple, clear, and immediate to win the sale in a chaotic market.
That promotional battle inevitably hits the bottom line, though. So let's tackle the financial consequence, the softer gross margin outlook for Q4. When we hear that, what does it actually mean, and what were the factors?
The margin pressure is really due to two related issues. First, the incremental need for a step up in promotions. They had to spend more aggressively to target those lower-end transactions under $6,000 that were weakest in Q3. You win those sales, but you pay for them with a lower margin.
And the second factor is a very technical concept that can throw people off: deleverage against fixed costs. Can you break that down for us?
Certainly. Think of it like this. Fixed costs are expenses that don't change based on how much you sell, like renting a massive warehouse or paying salaries for critical staff.
Okay.
The source material specifically mentioned warehousing. When the absolute volume of sales is lower than anticipated, as it was due to the macro environment, the same fixed costs that rent for the warehouse get spread over fewer products. The cost per item stored skyrockets, and that higher unit cost compresses your gross margin. It's a painful feedback loop when sales slow down.
That makes perfect sense. It connects the macro pressure directly back to the profitability.
And that's the strategic brilliance here. Recognizing that pain point and choosing to delay the expensive new room launch, which would require more fixed cost investment, to instead maximize efficiency and cash flow from the existing proven assets.
So what does this all mean? We've seen a company execute a highly disciplined pivot under pressure. They delayed a massive, risky launch to fortify their financial strength, while at the same time overhauling their marketing playbook for speed and rapidly investing in a completely new business model, the circular economy.
It means they are doubling down on their core superpowers: products designed to last, paired with agile customer acquisition engines. They're shoring up the weakness at the low end with snug and targeted promotions, while extracting maximum value from the high end through premiumization and high AOV.
This deep dive really shows that surviving a choppy market isn't just about hunkering down, it's about strategic redefinition.
It is. The company is actively building the infrastructure now to ensure that by FY27, they control the entire customer lifecycle through trade-ins and upgrades. Given this intense focus on harvesting the brand now and the projected future power of the circular model, think about this. What long-term competitive advantages might a furniture company gain when its primary strategic focus shifts from simply selling a new product once to effectively becoming the ultimate manager and guarantor of that product's lifetime value?
That shift from a single transaction to an endless upgrade loop fundamentally changes the relationship between the buyer and the brand, something to mull over as you contemplate the long-term value of your next home investment. We'll see you next time on The Deep Dive.